In this lecture, I'm going to explain what is bond. So I will be covering who issues these bonds and how these bonds are different from the stocks or shares, and what are the important terms to understand if we want to understand the bond properly, and why to calculate the present value of bond, and what is the interest rate risk, and some practicals. So starting with who issues this bond. Bonds are issued by the government or corporations when they want to raise money. Sometimes the government need money. So money can be collected from the public by issuing the bonds to the public. So the government is known as issuer, and the other people, they are known as the borrower who pay money to the government, and in return they get some money in the form of interest. Bonds are issued by the government, that we know, but by buying a bond, you are giving the issuer, means the government or the corporation, a loan, and they agree to pay you back the face value of the loan, for example 1000, on a particular date, maybe after 5 years, and to pay you the periodic interest payments. So periodic interest payments means maybe if it is 5%, then in the period is 1 year, so the amount will be calculated on the basis of the coupon rate, so that will be given to the person who has given loan to the government. So normally this is twice a year. So how these bonds are different from stocks? Unlike stock, bonds issued by the companies and give you no ownership right. But if you buy share, you will be considered as the owner of the company or corporation, because shareholders are the owner of the business, but the bondholders are not the owner of the business. So they are the creditors of the business. Market value of the bond changes over time, mean yield, as it becomes more or less attractive to the potential buyers. Now, what is the premium bond? Premium bond is a bond trading above its face value, or which is the cost is more than the face amount of the bond. The bond might trade at a premium because its interest rate is higher than the current market interest rate. So for example, the par value means the face value is 1000, and the same kind of bond is available in the secondary market at $1100. So that it means the investor is buying this kind of bond at a premium rate. So that's why this is known as premium bond. On the other side, there is a discount bond. A discount bond is a bond that is issued for less than its par or face value. Discount bond may also be bond currently trading for less than the face value in the secondary market. For example, par value or face value is 1000, and the same kind of bond is available in the secondary market at the rate of $900. So this is known as discount bond. So why to calculate the present value of bond? This is also very important. Bond valuation helps the investor to figure out what rate of return would make a bond investment worth the cost. So other terms that we can use, the first one is YTM, then coupon rate, and the current yield. So these are the terms that we need to understand how to calculate bond. Yield to maturity, YTM, as mentioned earlier, is a annualized return on a debt instrument based upon the total payment received from the date of initial payment, means initial purchase, until maturation, means maturity date at the end of the period. It means, let's say, so 5 years, first year plus second plus third and plus fourth and fifth. So this is the total yield to maturity. So this is the YTM. And what is the coupon rate? In comparison, the current yield rate is also there. So current yield on the bond is annual coupon income divided by current price of the bond security. So in this way, we can calculate the current yield. What is the current price of the bond? Now, An important distinction between bonds YTM and its coupon rate is YTM fluctuates over time, that is based upon the prevailing interest rate environment, whereas the coupon rate remains the fixed. Now, what is the relationship between yield to maturity and coupon rate? So, which is as follows: yield to maturity will be less than the coupon rate and current yield. So, it means the bond is being sold at premium to its par value. If the yield to maturity is more than the coupon rate and current yield, the bond is being sold at a discount to its par value. In case when yield to maturity is equal to the coupon rate and current yield, the bond is said to be traded at par value. So there is a minor difference. Yield to maturity means how much money the person is going to earn. If yield to maturity is less than the coupon rate is, for example, 8%, and yield to maturity is less than that, maybe it's 6%. So 6% is less than the 8%. It means uh, coupon rate is more, yield is less. It means the person is paying more for this. It means the person is paying more to buy the bond, the existing bond in the secondary market. So that is considered as a premium bond. Otherwise, discount. If the value is same, means YTM is same and current rate is same, it is traded at the par value. So now, what is the interest rate risk? Interest rate risk represent the inherent potential for monetary losses incurred by the lender from the fluctuation in the market interest rate. For example, the government or the corporation issue bonds, and what is the risk for them? So risk for them will be the interest rate risk. How? When look at this, when higher market rate interest rate, it means when the interest rate is more in the market, what will happen? The government bonds will not be so attractive. So if it is not attractive, mean lower the fixed rate bond price. So bond price will be go down. If the bond price will go down, it means we will be able to buy at a discount rate. And if we buy at the discount rate, it means the yield will be higher. On the other side, when the lower market interest rate in the market, bank rate is very low, let's say 3%, but the bond which is available is like 9%. It's more attractive. So if it is more attractive, more demand for the particular product, and same way the more demand for this bond will be there, higher fixed rate bond price. So price of the bond will be higher. What kind of bonds? Fixed rate bond. Normally these are the fixed rate bond with a coupon rate. So when it is more attractive, we'll buy at a higher price. When we buy at a higher price, no doubt there will be lower bond yield. So this is how we can evaluate the interest rate risk. So now I'm going to explain this with one example in Microsoft Excel. Look at this. Let's say we have a coupon. So coupon rate that we never change. Let's say this is 6%, and the yield in the market is, let's say, 7%. We have par value is 1000, and how many number of years? Like 5 years. So we can calculate the present value of the bond with the help of Microsoft Excel. Let's say number 1 and 2. I'm just going to drag it down here. 1, 2, 3, 4, and 5. So even again the fifth year, if I write here 5 more, because in the fifth year we want to add one more value. First of all, the cash flow. For example, I have bought the bonds with the coupon rate and yield is a 7%. So coupon rate, it means I have spent, let's say, $1,000, which I will receive at the end of the fifth year, $1,000. So here this $1,000 I'm just writing here exactly as it is. So $1,000 that I will receive. Second, now what I will receive apart from the 1,000, I will receive uh, cash flow. So what is the cash flow? $1,000 multiply. So this is the $1,000. If I say I want to fix this $1,000 with putting a dollar sign, so it means absolute value. I'm going to fix it. So multiply by 6%. So it should be 6%, right? So $60 I'll see every year for next 5 years. So this is the amount that we will receive. Now what I want, the value, the $60 I will receive after first year, again $60 after second year, end of the second year, let's say end of the third year I'll get $60, and so on the fifth year I'll get 60 along with $1,000 which we have invested today. Now, but what I want to know what is the present value of the $60 which I will receive after 1 year. So how to calculate? So there is the present value factor, PV factor, is equal to 1 divided by 1 plus what is the rate here. So here that I'm going to calculate the rate 7%, bracket close, and it's raised to the first year. So first year that I click over here and enter. So this is the present value factor that I have calculated. It means if I have $1 today, the value of the $1 will be exactly equal to the present value of this 0.93. So if I want to calculate the present value of the cash flow, that will be 60 multiply by present value factor and enter. So 56. And same way, if I want to calculate the present value factor for the next 2 years, then I need to go with this. Okay, so how this is coming? This is because that I have not put here here J2. So J2 is this one, right? So I don't want to change it. I want to fix it. So to fix it, I need to put a dollar sign. So here I put here J $2 and enter. Now in this way that I will be able to make it. So we have a present value factor, and here we multiply the $60 into present value factor, and we have all these figures ready. So what I say, if I make it total of these are the dollar value actually. If I want to go with the 2 decimal places, I can click here and use 2 decimal places. So $959. It means if the yield, I mean the current rate is a 7%, and I can buy this bond at 959, that will be okay. Even if I spend less than this money, even then that will be really good. So in this way we can calculate the present value of bond. Let's say if I change, we cannot change the coupon value because this is issued by the issuer, but we can change the bank rate or current rate which is prevailing today. For example, the today is let's say 9%. Enter. Automatically all these figures change. So it shows that if the market rate is 9%, then we can buy bond at 883. It should be less than this. I need to spend, if I want to buy it, I should spend less than this or equal to. On the other side, if today rate is 3%, then this is the current market rate or the bank rate. So definitely the bonds will be more attractive. If the bond will be more attractive, so it will be sold at a premium rate, so 1137. But I should not buy more than this. If I will be able to buy this less than this, that will be really good. If it is equal to this, even then I will be able to get 6% return. Sure. So this is the relationship between this. Now, look at on the left hand side. What I say, exactly the same thing we can calculate with the help of one formula, which is known as uh, how to calculate the present value of the bond with the built-in formula in the Microsoft Excel. So write the PV, the rate. So rate here is uh, we're talking about the rate. So rate here is let's say 3%, right? Comma, we have NPR. So NPR is the total number of payment period per year. So 5 years we have selected. So I have selected this 5, comma, if a payment we talk about $60, this is the payment every year in this case. Future value at the end of the period, mean on maturity date, I'll get $1,000. And when this all the payments will be received at the beginning or at the end of the period, I say at the end of the period, bracket close and enter. So it will be minus amount. It means it shows that if I spend $1137.39 today, then that will be really good. If I should not spend more than this money. Why I am buying at the premium? Because the value is 1000. I'm ready to buy at this point. Even then that's great because the current yield rate is less. If the current yield rate is more than this, let's say 8%, then I should spend 920, not more than that. So this is how we can evaluate and calculate the present value of bond.